Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you this morning, and as always, make sure you do send us your questions to Brian Rezny at ReznyWealth.com. We've just released a groundbreaking report. The 3 biggest risks you must avoid now. We've had a lot of new clients in 2022. We expect a lot of new clients in 2023. We've had tremendous outcries from our TV and radio show listeners alike. And what we've done is we want to help you prosper not only this year, but in the future. So with that, I sat down with my staff at the end of the year. We wrote a report, the 3 biggest risks you must avoid now. If you're a pre-retiree or retiree and you have at least a $500,000 portfolio, go to ReznyWealth.com and make sure you click on the special report tab and download that report. It's free. Protect your money. Protect your money from bad advice. Don't be sold by Wall Street firms, banks, a lot of these annuity charlatans. There's just too many of you investors that we work with that we find you've been taken advantage of. The advice you're getting is substandard at best. You've been sold products that you should have never been sold. Your investment returns are lackluster. All these conflicts and bad advice can do really one thing for your retirement, and it could put in ruins. You need to protect your money. And if you want to protect your money, there's one great way to do it, which is go to ReznyWealth.com and download the 3 biggest risks you must avoid now. Well, let's talk a little bit about what happened last year in 2022. Your set it and forget it asset allocation portfolio. You remember I talk about that failed pie often on my TV show? Well, it didn't work last year again. In fact, people that did these 60-40, 50-50 portfolios, meaning 50% bonds, 50% equity stock, you failed miserably. Not only did your stocks go down, but your bond portfolio, chances are, went down twice as much as the stock market went down. And people often say to me, but I thought bonds are safe. Bonds can be as risky from time to time as the equity market. And so the problem that you're going to have going forward is if you continue to do stock asset allocation, which is computer generated by these Wall Street firms and banks, you're probably going to fail again. There's times you want to own less bonds or different kinds of bonds, or maybe no bonds at all in your portfolio. Maybe it's more appropriate, instead of just stock asset allocation, set it and forget it that you're experiencing, maybe it's smart to go a little bit more cash. And from time to time, maybe more equity. So again, as a real money manager, Rezny Wealth Management believes in active management, making these adjustments to portfolios when necessary, not set it and forget it, not blindly doing asset allocation, a 50-50 portfolio, because quite frankly, the days of asset allocation and set it and forget it, folks, are over if you care about the return on your money and the return of your money. The best opportunities for 2023, I'm often asked that as the year comes into a new one. And let's talk about it. You know, last year in 2022, I talked a lot about healthcare. I talked a lot about energy and oil. And guess what? Both those sectors were actually great opportunities in 2022. What am I expecting for 2023? We continue to like healthcare as a sector, and we continue to like energy. Remember, the current administration has a virtual war against the energy enterprises, not only here but around the world. What is that going to do for supply and demand? There's going to be less supply, demand's increasing, prices go up. Great opportunity for investors. But again, do your homework. Another year of spectacular speculation ruins. Let's talk about that just a little bit. What we've seen with a lot of new clients coming into our firm, you had bad returns last year, but not only did you have bad returns, you lost a lot of money with either your self-managed portfolio or with that so-called advisor. Speculation does not work. If you're buying what was hot the year before, you're going to get burned the next year, and that's statistically if you look at numbers from the last 30, 40, 50 years. If you speculate, you're going to be the big loser. If you chase last year's big winners, you're probably going to lose a lot of money the next year. Remember that. So again, a lot of research, buy quality valuation, and assets that actually have the ability to generate future revenue and growth so that you have an opportunity for that portfolio to get more wealthy or go up over time. That's the key. When buying last year's winners is always a bad idea. And again, when we look at what did best, those are usually the things do the worst in the future year. So remember, protect your money. Don't let emotions or greed overtake a good decision or good investment research. Never buy the hot winners from the year before, because ultimately it's going to ruin your portfolio. Emotions are going to ruin your retirement. I've talked about that many times over the years. Again, I've been managing money and educating you, the investor, for well over 30 years. When investors throw emotion into investment decisions, it's going to be a big loser. You know, we had a number of phone calls from potential clients last year to our firm. We manage a lot of money. We have a lot of current clients. And the one thing that I will say that I've learned over 30 plus years of managing money and educating you, the investor, is if you allow emotions to run rampant, meaning the world's coming to an end, you read some crazy internet email about buy gold now or things of that nature, and you're reacting to these things knee-jerk, you're going to lose. And I know there's probably half the people that listen to my show, if you're honest with yourself, you know you've made these mistakes before. Where, oh my gosh, the world's coming to an end. We should sell everything right now. And you sell at the bottom. And then you want to reinvest the money when things are rosy and good. That is always a classic, a bad mistake, and often will really wreak havoc on your portfolio. If you want to protect your money from bad advice, if you want to learn the 3 biggest mistakes you must avoid for 2023, go to ReznyWealth.com and click on the Special Reports tab. I've just released this groundbreaking report, the 3 biggest risks you must avoid now. If you care about your retirement, if you care about your retirement security, your portfolio, and your financial health, you must read this report. It covers the pitfalls that really plague a lot of retirees. It covers the pitfalls that plague investors and why you often make less money and you lose more. Is it from bad advice? Yes. Is it from hiring the wrong firm to manage your money? Yes. Is it often from self-managing your own money and really not doing the real work, homework, due diligence you need to before you start investing your money? Yes. We're going to cover all those in this free special report, and the only way to get your copy is you have to visit ReznyWealth.com, click on the special report tab for your free instant download. Before I go to a quick commercial break, again, make sure you send your questions to Brian Rezny at ReznyWealth.com. We love hearing from you. We like answering your question. We want to educate you, because remember, the question you have, probably another 1,000 listeners right now have the exact same question. Dale from Cape Coral, Florida. I have a small IRA, $25,000, and use trailing stop orders to allow me not to check my account. My question is, do you have any advice on what percentage I should use in individual stocks as well as ETFs? The first thing I would say to you, Dale, is I do not like trailing stops. Okay, if you are not looking at again, it's not the account value, but if you're not looking at every position every day and doing research, now again, not that it's going up and down, you're looking at the positions you own. So if you own 5 stocks and one is Facebook as an example, you better be doing hardcore research on Facebook every day. Now Facebook could drop for no real reason other than maybe some short-term bad news, and it bops you out and you have a permanent capital loss. But if you feel that you've done proper research and that stock should rebound nicely and go to new high ground, your trailing stop has just failed you in a bad way. How much money, your real question on individual stocks and ETFs, it's really personal preference and how you want to diversify the portfolio and your risk profile. So there's not a right or wrong answer. What I will say is this: when you're dealing with individual stocks, you better be ready to spend at least 30 to 40 hours a week minimum researching all the stocks in your portfolio. You better have a discipline, a strategy, because individual stocks take a whole bunch of time in order to manage them properly. And don't just buy what you've heard of. Don't just buy the big name companies, because that is, again, the reason a lot of investors don't do well with their money. They buy Apple because it's Apple, and they think it's always going to go up, and that's simply not the case. I'm going to take a quick break. We'll be right back with more questions after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. I hope you're enjoying today's program, and as always, send your questions to Brian Rezny at ReznyWealth.com. Make sure you visit our website. We've just released a groundbreaking report, the 3 biggest risks you must avoid now. If you're at all concerned about lack of return on your portfolio, if you're concerned about potential conflicts from your Wall Street firm, bank, or maybe you got bamboozled into buying one of these annuities from one of these annuity charlatans, this is a must-read report. I'm going to teach you how to protect your money from bad advice, what risks you must avoid for 2023, and really how you can ultimately prosper and really protect your financial security from ultimately the biggest risk you have, and it's covered in that report. Tim in Naples, Florida. I was sold 2 equity index annuities and 1 variable annuity 5 years ago. None have done well. I heard your show last week and you hate annuities. What can I do to get out? Tim, the first thing is remember, we hate annuities. You should hate annuities. There's no reason ever to buy an annuity, period. Annuities are layered with fee after fee after fee. And I know these guys that sell annuities will call themselves an advisor. They're not. They're salespeople. They'll tell you about all the good stuff in annuities, but they're not going to tell you that in an equity index annuity, as an example, you're going to be lucky if you average 1 to 1.5% annualized return over a decade. That's miserable. You can make more than that in a CD in the bank and have liquidity. There's expenses on equity index annuities. There's expenses on variable annuities. All annuities have lockup periods, unfortunately, and you should never buy an investment that has a lockup or a surrender penalty. It doesn't make sense. So what you need to do, Tim, you need to look at what the penalty is to get out of your annuity early and decide if you take it out and take the penalty now, is it better to take some pain now than keep that annuity 5 or 8 or 10 more years until the surrender penalty is gone and you basically haven't made any money on that equity index annuity that you were so promised it was going to be the best investment ever. They're garbage. Stay out of them. Dennis in Naples, Florida. What do you think about variable annuities and life insurance for an IRA rollover? That is what my advisor is suggesting. Dennis, don't do it. Your advisor is not an advisor at all. Your advisor is selling insurance products and annuities for an IRA that's already tax qualified. Number 1, it is a prohibited transaction by the IRS to put an IRA or qualified money into an insurance policy. So what you'd have to do in order to do that, you'd have to pull the money physically out of an IRA, pay tax on it, which would make no sense, and then buy an insurance policy. That's a downright scam by the so-called advisor. Do not do it. As for a variable annuity inside an IRA, that makes 0 sense also. Again, you've got fee on top of fee on top of fee. The average variable annuity that my firm has reviewed, that we have saved you, the TV and radio show listener, from heartache, the average one we've looked at is between 3.5% and 4.5% every single year on cost structure. That's horrific. So imagine if the portfolio makes 7 and your cost structure is 4.5%. What are you left with? Basically nothing to take a whole bunch of risk of the bond market or equity market. Zilch. Do not do it. You need to find yourself a real advisor. What I would suggest you do is go to ReznyWealth.com, click on the special report tab, download our recently released report, the 3 biggest risks you must avoid now. Read that report. It's going to talk about the so-called advisor. It's going to talk about suitability, fiduciary, why you need to protect your money from bad advice, and really, again, managing money for over 30 years, I see so many of you retires and pre-retires harmed because your advisor is, again, no more than a salesperson selling products he or she is required to sell that are substandard at best with crazy expenses that ultimately rob your hard-earned money, your returns, and takes your retirement and puts it in financial ruins. Protect your money from bad advice. Go to ReznyWealth.com. Download the 3 biggest risks you must avoid now. Taylor in Cape Coral, Florida. I own a lot of bond investments. Can you explain bonds and why bonds lost money last year? Taylor, great question. So what happens is bonds are like a teeter-totter. So on a teeter-totter, when one end goes down, the other end goes up. So what happened last year in 2022, what happened to interest rates? Interest rates went up. So as interest rates go up, your bond value goes down. Bonds are not safe investments. Bonds can be as volatile, and different kinds of bonds can be even more volatile than the equity market. So duration has a factor, the type of bonds you own. What I would say to you is this: if you own a lot of bonds in your portfolio, why do you own a lot of bonds in your portfolio? That's the question for you. Are you getting proper advice from your current financial institution, your money manager, or do you not even have a money manager? You've got an advisor working for one of the big Wall Street firms that keeps selling you bonds that benefit them and clearly are harming your portfolio. So again, bonds go down when interest rates go up and vice versa. There's times you want to own more bonds. There's times you want to own less bonds or no bonds. So don't have a static portfolio. You don't want to trade every day either, but there's times you want to make adjustments to how your money is positioned or allocated based upon changing economic times. I think too many investors, unfortunately, buy investments, park them away in the portfolio, and never really revisit these things until 3-5 years passes and you realize your returns have really been lackluster, or you've lost a lot of money that can no longer be recouped in your portfolio. That's a bad scenario. Phil in Boca Raton, Florida. What is your market outlook for the next 6 months and the next 3 years? There seems to be a lot of recession calls. Love your show. Thanks for the nice comment, Phil. You know, if you talk to or listen to half the newscasts on mainstream media, half of the people are calling for recession, half are calling for no recession. So the bottom line is this: recessions are not necessarily bad. It's a temporary slowdown in the economy to kind of size things, and then you get back to moving in the right direction, in our opinion. So realistically, we already went through a mild recession or rolling recession in certain parts of the economy in 2022. We're going to continue this rolling recession in different parts of the economy in 2023. So again, recession's a temporary slowdown. It's not the end of the world. And what happens, though, is different parts of the investment market will get negatively reacted and overreacted. So it is really actually a great time to look at your laundry list of investments you may want to buy. And if those get overly beat up and they become very inexpensive and cheap but have great future opportunity, that's when you want to back up and really load the boat on quality assets. So recessions shouldn't be feared. They should be embraced. And again, they're temporary in nature, and at the end of the day, they're great opportunities for smart investors. I'm going to take a quick break. I'll be right back with more questions after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. I hope you're enjoying today's program. Again, send your questions to Brian Rezny at ReznyWealth.com. We'll try to get to as many of those as we can on today's program. By the way, when you visit ReznyWealth.com, we're getting a lot of calls and interest for our groundbreaking report. I've just released the 3 biggest risks you must avoid now for 2023 report. It covers the pitfalls and the issues that too many of retirees and pre-retirees unfortunately hit their portfolio, hit their bottom line, and really ruin your financial security. So if you're at all concerned about the advice you're getting, if you're questioning some of the investments in your portfolio, go to ReznyWealth.com. Download our updated report, the 3 biggest risks you must avoid now. It's free. It's only available at ReznyWealth.com. Click on that special report tab. Get your instant download. Protect your wealth from bad advice. prosper, and really solidify your financial retirement security, which so many of us have worked hard for. This report's going to cover what you need to do and what you should avoid in 2023. Let's go to Doug in Alaska. My advisor went to cash 4 weeks ago at the market bottom. Not the first time he's done this. We lost a lot of recovery. Now I question his ability. Help. Doug, great question. What we often find is there are a lot of advisors, again, who are really acting in a sales role. They're not fee-only fiduciary money managers like a Rezny Wealth Management. And what I often find, we'll get 4 or 5 or 6 clients a year that'll make the same comments you did, Doug, where my advisor went to cash, or he sat the sidelines for the last 6 months and everything rallied back and we lost a bunch of money. We hear this all the time. A lot of times what happens is these advisors get more nervous and skittish than you do. That's not a good sign, and certainly not a good advisor. Make sure the firm that you hire is a fee-only fiduciary money manager. Those are the only kind of firms that actually legally work in your best interest 100% of the time, actually manage your money, and will help keep the emotion part out of it from that so-called advisor and or even potentially the client. So again, if you go to ReznyWealth.com, you're more than welcome to hit that special report tab. We've got real advisor, fake advisor. You might want to download that report, read it, brush up on who you entrust your money to. It's a great way to protect your wealth in the future and get the advice you truly are looking for, and truly will help you, again, secure your retirement. Phil in Cape Coral, Florida. Can you explain stagflation and its impact on the economy and the stock market? Great question. So basically, what's stagflation? Stagflation is the economy itself is not growing at all, but we have very, very high inflation. That's not a good sign. We currently do not have stagflation, although that could happen sometime in 2023. The economy is clearly slowing down in certain sectors. We have a rolling recession, as I've talked before, and I think a lot of investors need to realize some of what's in your portfolio, especially if you're doing that stock asset allocation, more that set it and forget it mindset. These are the times right now that you probably want to be looking for better opportunities for parts of your portfolio. So again, stagflation is currently not here, but I think we'll see parts of stagflation in parts of the economy, especially the U.S. economy, in 2023. What I will say to you is this. If you look at places like Europe that are 20, 30 years ahead of us, they've seen a lot of stagflation over the decades where they have no growth, lots of inflation, and again, as I've talked before, not a great place to invest is Europe, and it's an area you definitely want to avoid. John in Cape Coral, Florida. Energy pricing and oil. Do you see further upside in oil prices? John, great question. Now, fair disclosure, we do own positions in various oil companies and oil investments, and we have for the last couple years, and they've actually done quite well. We see continued upside potential. And that doesn't mean that we're not going to change our thesis at some point. It depends really what's going on in the economy and the overall investment markets. So again, with the current administration and their war on fossil fuels, what does that mean? What it means is we have a lesser supply. We have the demand pickup, and obviously China's coming back online after 3 years. There's going to be more consumption of fossil fuels, and we have less supply. Prices are going to realistically go up in 2023. We see that. Now, if there's a wholesale change to the administration, which we don't see the current administration anyway, oil prices realistically are going to go up. We're going to probably see $4 or $5 gas sometime in the near future. And I think energy companies are going to, again, continue to make record profits, unfortunately, because of bad policy by the current administration. Bob in Naples, Florida. Do you think a dividend strategy is best for a conservative retiree? Bob, there's no one strategy that is best for a conservative retiree. And a dividend strategy is not necessarily conservative. What a dividend strategy is, you're looking at equities generally speaking, and they could be small, mid, or large cap equities, and you're looking at stocks that have an above average dividend, and they have grown dividend over a long period of time. Remember, even dividend stocks can drop 50-60% in a matter of days or weeks. So when people say, oh, is a dividend strategy safer than, let's say, a growth strategy? Not necessarily. It's the research you've done. It's your strategy you're running. We like dividend stocks right now, especially going into 2023. We think there's more value there right now. So what I would say is, while there's great opportunity in the growth sector, I think having a good percentage of good quality dividend paying growing stocks for a total return basis is a great opportunity in your portfolio. Ryan in Cape Coral, Florida, what do you think about Alibaba? You know, that's a great question. Alibaba, if you look at the last 3 years, that stock has just been pummeled. Now with China reopening, it seems like China and some of their rules and regulations may be, let's say, softening a bit. There may be some opportunity for Alibaba. But generally speaking, we continue to see the best opportunities in U.S.-based stocks that are fairly priced, that have growth potential, and ultimately I think a lot of investors really need to look at valuation. Before you buy something, don't buy a stock just because you've heard of it or you use their product. Is the stock of quality? Does it have growing earnings and revenue? Is it fairly valued or undervalued so you have future opportunity? That's the most important thing you can do. Here in Cape Coral, Florida, I worked for Ford for 40 years. Now retired, still own a lot of the stock. What are your thoughts? I think Ford's a great company. I don't think it's a great stock. I do not like auto stocks in general. They are low margin business. They have huge spikes up and huge spikes down. They have big periods where they lose money, big periods where they make money. But the problem is they're so intense in capital, there's just better places to invest your money, in our opinion. So I would avoid Ford, and if you have a lot of money in Ford, you should be substantially trimming your position. Remember, never own more than 5% of any one individual company. None. It's a big mistake. Too many investors, they work for a company, they accumulate stock, they never sell appropriately and reduce position. Every stock can go out of business. Every stock can drop a lot. You, the investor, have to realize, do the right thing with your money, and there's times you need to reduce exposure. We're just about out of time, folks. Go to ReznyWealth.com. If you're tired of bad advice, poor client communication, and just feeling like your advisor is just not up to the job, call Rezny Wealth Management for real money management and real advice. If you're at all questioning the direction of your portfolio, if you're realizing that Wall Street firm or bank or the person who sold you the annuities really sold you the bag of goods and they're not keeping up, call Rezny Wealth Management. We're a fee-only fiduciary money manager providing exactly what you need. Real money management, real advice, excellent client communication. Make sure you go to ReznyWealth.com. That's ReznyWealth.com, and download our current report, The 3 Biggest Risks You Must Avoid Now. It's free and it's currently available at ReznyWealth.com.